Night falls over Abadan in the spring of 1951. The oil refinery, the largest on Earth, keeps running, flames licking the darkness as tankers sit idle along the river. Inside distant boardrooms, ledgers no longer balance. In London, officials stare at figures that refuse to make sense. A country that believes it owns this oil is suddenly cut off from it. No invasion. No declaration of war. Just a decision taken far away that will drain Britain's finances and expose a quiet truth. Empire now depends on resources it no longer controls. The question is not how Iran took its oil back. It is how Britain discovered too late that it could not afford to stop them. For decades, British power in the Middle East had rested on a simple assumption. Oil flowed because Britain said it should. The Anglo-Iranian Oil Company, majority owned by the British government, extracted, refined, and exported Iranian oil on a scale unmatched anywhere in the world. The profits stabilized Britain's balance of payments. The fuel powered its navy, its industry, and its post-war recovery. On paper, this looked like control. In reality, it was dependence disguised as ownership. The arrangement dated back to the early 20th century. When concessions were negotiated under unequal terms, Iran received royalties. Britain received everything else: pricing power, management authority, and strategic security. By the end of World War II, that imbalance had become politically explosive. Iran was poorer than its oil suggested it should be. Britain was richer than its domestic economy alone could justify. Both sides knew it. Only one could change it. Post-war Britain entered the late 1942s, financially exhausted. Victory had come at immense cost. Overseas reserves were thin. The pound was fragile. Energy imports mattered more than ever, and Iranian oil was the cheapest and most reliable source available. The refinery at Abadan was not just an overseas asset. It was a pillar of Britain's economic survival. Losing it would mean more than reduced profits. It would mean fewer dollars, higher import costs, and deeper dependence on external support. In Iran, the political climate hardened. Parliamentarians demanded transparency and fairer terms. Public anger grew as comparisons circulated how much oil Britain extracted versus how little Iran earned. When negotiations failed to deliver meaningful reform, the demand shifted from revision to control. Nationalization was no longer radical. It was popular. In March 1951, Iran's parliament voted to nationalize the oil industry. The decision was legal under international law, but it was catastrophic for Britain's calculations. Overnight, the Anglo-Iranian Oil Company lost access to its core asset. Tankers were turned away. British technicians prepared to leave. The flow of oil that underpinned Britain's energy security slowed, then stopped. London's response was swift and severe. Officials believed that Iran would collapse without British expertise and markets. Sanctions were imposed. Legal challenges were filed. A global blockade of Iranian oil was quietly organized. The expectation was simple: pressure would force Iran to retreat. Britain had used this strategy before. It assumed it would work again. It did not. Iran endured the immediate shock. Oil revenues fell sharply. But Britain absorbed damage it had not anticipated. The loss of Iranian oil cut into export earnings at the worst possible moment. Britain needed dollars to pay for food, fuel, and raw materials. Without Abadan's output, those dollars became harder to secure. The balance of payments crisis deepened. The pound came under renewed strain. What looked like an assertion of imperial authority became a financial trap. Sanctions reduced Britain's access to oil more than Iran's ability to sell it in the long term. Alternative suppliers charged more. Shipping costs rose. Energy rationing loomed again at home. Each month, the standoff continued. Britain paid more to sustain its position than Iran paid to resist it. This was the first major turning point. Britain realized it was fighting an economic war it could not win cheaply. The empire's leverage depended on control of resources abroad. But control required cooperation. Once that cooperation ended, power had to be enforced through markets and money, and Britain no longer dominated either. Behind closed doors, officials debated the unthinkable. Could Britain maintain global influence without guaranteed energy supplies? Could it afford prolonged confrontation in the Middle East? The answers increasingly were no. Yet backing down carried its own cost. The precedent that imperial assets could be seized and defended successfully. The oil crisis in Iran exposed a deeper problem. Britain's post-war economy was too weak to sustain imperial enforcement. The empire had become a liability precisely when it was meant to be an advantage. Oil, once a source of strength, now threatened bankruptcy. This story matters because it marks a transition. The loss of Iranian oil was not an isolated dispute. It was an early signal that economic power had shifted. Britain could no longer dictate terms through ownership alone. Energy dominance required financial dominance, and that had already begun to slip away. As the standoff hardened and costs mounted, Britain faced a choice it had spent decades avoiding: escalate and risk economic collapse, or retreat and accept a diminished role. The decision would not be announced in speeches. It would unfold through accounts, sanctions, and silent admissions of weakness. In the next phase, the conflict would move beyond nationalization. It would draw in allies, reshape global energy markets, and accelerate Britain's financial decline. What began as a dispute over oil was becoming something far larger. A lesson in how empires fall when the resources they rely on are no longer theirs to command. By the summer of 1951, the oil dispute had stopped being a negotiation and started becoming a siege. Not a military one, but a financial and commercial blockade designed to break Iran's resolve and to restore Britain's access to oil without firing a shot. British planners believed time was on their side. Iran, they argued, lacked the technical expertise to operate Abadan. Without foreign buyers, its oil would rot in storage tanks. Revenue would vanish. Public pressure would rise. Eventually, Tehran would be forced back to the table. What they underestimated was how much Britain itself depended on the very system it was trying to weaponize. The embargo was comprehensive. British tankers refused to load Iranian oil. Insurance firms, shipping companies, and refineries were warned away. Legal threats were issued against any buyer who dared touch nationalized crude. On paper, this looked like control of the global oil market. In practice, it exposed Britain's shrinking ability to enforce that control alone. Almost immediately, the costs began to surface. Iranian oil had been cheap. Its loss forced Britain to buy from alternative suppliers at higher prices, often in dollars. Every replacement shipment worsened Britain's balance of payments problem. What had once been an overseas profit center was now a drain on scarce foreign currency reserves. Inside the treasury, the numbers grew alarming. Energy costs rose. Export earnings stagnated. Dollar shortages, already a chronic post-war problem, became acute again. Britain was still recovering from wartime debt, still dependent on external financing, still vulnerable to currency pressure. The oil standoff magnified every weakness at once. At the same time, Iran did not collapse. Production fell, but it did not stop permanently. Engineers learned. Smaller buyers emerged. Smuggling routes formed quietly. More importantly, Iran reframed the conflict as one of sovereignty rather than economics. That framing mattered. It brought political resilience even when finances were strained. Britain's strategy now relied on something it no longer fully controlled: international alignment. The United States became central to the crisis. American policymakers had little sympathy for Britain's colonial claims, but deep concern about instability in a strategic region. They wanted oil flowing again, but not at the cost of open confrontation or economic chaos. For Britain, this created a dilemma. Without American cooperation, the embargo would leak. With it, Britain risked losing control of the outcome. Pressure behind the scenes intensified. British officials argued that nationalization, if left unchallenged, would encourage similar moves elsewhere. Energy assets across the Middle East could follow Iran's example. The financial consequences for Britain would be devastating. But the United States viewed the situation differently. From Washington's perspective, Britain's rigidity threatened broader economic stability and political influence in the region. As months passed, Britain's bargaining position weakened further. Maintaining the embargo cost money every day. Each delay increased the risk of domestic energy shortages and renewed austerity. Publicly, officials insisted on firmness. Privately, doubts grew. The conflict had entered a dangerous phase. Escalation without leverage. Legal avenues failed to deliver quick results. International courts moved slowly. Diplomatic pressure produced stalemates. Iran refused to reverse nationalization outright. Britain refused to accept a settlement that reduced its control. The oil remained underground or unsold, while costs mounted on both sides. But the asymmetry was clear. Iran was losing potential revenue. Britain was losing existing income and spending precious reserves to replace it. One side was foregoing gains. The other was absorbing losses it could not afford. By late 1951, the situation began to affect Britain's wider economic strategy. Plans for reconstruction had assumed steady energy supplies and export earnings. Both were now uncertain. Confidence in sterling weakened further. International markets took note. Britain's claim to be a stable financial anchor looked less convincing with each passing quarter. The oil dispute was no longer just about Iran. It was reshaping Britain's global standing. This realization forced a subtle shift in tone. Officials began exploring compromises they had previously rejected. Profit-sharing models were reconsidered. Management structures were debated. But every concession came too late to restore the old arrangement. The era of unilateral control was over. Meanwhile, the geopolitical stakes rose. The longer the crisis lasted, the more external actors took interest. Energy markets adapted. New suppliers gained ground. Iran's defiance became a symbol watched closely across the developing world. Britain's difficulty in forcing its will became equally visible. What had begun as a confidence-driven gamble was turning into a strategic miscalculation. Britain had assumed that ownership guaranteed obedience. Instead, it discovered that ownership without legitimacy required constant, costly enforcement. In a post-war world of fragile finances and shifting alliances, that enforcement was no longer sustainable. By the end of 1952, the oil war had drained Britain more than it had broken Iran. The empire's economic logic was unraveling. Every attempt to tighten pressure exposed another weakness. Every delay deepened the financial wound. The crisis was approaching a breaking point, not because Britain lacked power, but because it could no longer afford to use it the way it once had. In the next phase, that contradiction would be resolved decisively. The struggle over Iranian oil would end not with a return to the past, but with a transformation of control itself, and with costs that Britain would carry long after the oil started flowing again. By 1953, the oil dispute had hardened into a stalemate that neither side could sustain indefinitely. Iran's economy was strained, but intact. Britain's position was more precarious than its public posture suggested. What had begun as a fight over ownership had become a test of endurance, and Britain was running out of room to maneuver. The breaking point came quietly, inside balance sheets rather than battlefields. British officials now faced an uncomfortable truth. Even if Iran were forced back into a negotiated settlement, the old system could not be restored. The costs of the embargo, the loss of revenues, and the exposure of Britain's financial fragility had already done lasting damage. Markets had adjusted. Confidence had shifted. The world had seen that Britain could be challenged and made to pay for it. This realization changed the nature of the conflict. The focus moved away from reclaiming control and toward limiting losses. The question was no longer how to force Iran to surrender its oil, but how to re-enter the system without appearing to accept defeat. That distinction mattered politically, but economically the outcome was already clear. Behind closed doors, Britain leaned more heavily on its ally across the Atlantic. American influence grew decisive. Washington's priority was stability, steady oil flows, predictable markets, and containment of wider disruption. Britain's imperial claims were secondary. If Iranian oil was to return to the market, it would do so under a new structure. That structure fundamentally altered the balance of power. Instead of a single dominant operator, control would be fragmented. Management would be internationalized. Profits would be shared more broadly. Britain would retain a stake, but not supremacy. The arrangement ensured oil flowed again, but it also ensured that Britain could never again dictate terms alone. For Britain, this was a strategic retreat disguised as compromise. The financial consequences were immediate. Revenues returned, but at a lower level. Energy security improved, but at a higher cost. The balance of payments crisis eased temporarily, but the structural weakness remained. Britain had avoided collapse, but only by surrendering leverage. Iran, meanwhile, had achieved something unprecedented. It had nationalized a critical resource and survived the retaliation. Even though it did not gain full control in the long run, it had shattered the assumption that imperial ownership was untouchable. The symbolic impact echoed far beyond oil. This was the moment when Britain paid the real price. The empire had relied on a network of overseas assets to compensate for domestic economic limits. Iranian oil had been one of the most important. Losing dominance over it forced Britain to confront the gap between its global commitments and its financial capacity. That gap widened rapidly. Defense costs remained high. Overseas obligations persisted, but the revenue base that had supported them was shrinking. One by one. Assumptions underpinning imperial strategy failed. Britain could still project power, but doing so now required borrowing, negotiation, and restraint. The oil war exposed an uncomfortable hierarchy. Financial power now outranked ownership. Alliances mattered more than titles. Control depended on markets, not flags. Britain was adjusting to a world where it was no longer the central node. Who benefited from this shift? Iran gained recognition of its sovereignty and a share of revenues that better reflected its resources. The United States consolidated its role as the indispensable mediator and financial anchor of the post-war order. Global oil markets became more diversified, less dependent on any single imperial authority. Who paid the price? Britain did slowly, steadily, and mostly out of public view. The cost was not measured in one dramatic loss, but in reduced influence across multiple fronts. Energy policy became constrained. Foreign policy became more cautious. Economic planning grew defensive. The oil dispute also set a precedent. Other producing nations watched closely. They saw that confrontation carried risks, but also that it was possible. Britain's experience in Iran weakened its bargaining position elsewhere. Each negotiation now occurred under the shadow of what had already been lost. By the mid-1950s, the immediate crisis had passed. Oil flowed again. Markets stabilized. Headlines moved on. But the deeper shift was irreversible. Britain no longer controlled the energy lifeline that had sustained its global role. It participated in a system it did not design and could not dominate. The financial shock of the Iranian oil war had accelerated a transformation already underway. The empire did not collapse overnight. It eroded asset by asset, concession by concession, under the pressure of costs it could no longer absorb. In the final phase, the consequences of that erosion would become unmistakable. Britain's retreat from imperial dominance would speed up, driven not by ideology or defeat, but by the quiet arithmetic of energy, finance, and survival. By the mid-1950s, the oil crisis with Iran was officially over. Tankers moved again, refineries operated, contracts were signed. On the surface, normality had returned. But Britain's position had fundamentally changed. The resolution of the conflict did not restore what had been lost. It confirmed it. The new oil arrangements ensured supply, but they also locked in a reality Britain could no longer escape. It was now one participant among many, not the commanding force. Control had been replaced by coordination, ownership by negotiation. What looked like stability was, in truth, adjustment to diminished power. The financial consequences continued to unfold long after the headlines faded. Iranian oil had once provided Britain with cheap energy and strong foreign earnings. Under the new system, revenues were shared and costs were higher. Britain's balance of payments problem never truly disappeared. It resurfaced repeatedly in the years that followed, forcing emergency measures, devaluations, and dependence on external support. The oil war had revealed a structural weakness that could not be patched over. Britain's global influence had relied on overseas assets to compensate for domestic limitations. When those assets became contested, the entire imperial model began to fail. The state could no longer guarantee access to critical resources without external approval. Energy security was no longer a tool of power. It was a vulnerability to be managed. This shift had immediate strategic implications. Military planning had to change. Diplomatic ambition narrowed. Overseas commitments were re-evaluated not in terms of prestige, but cost. The logic of empire control resources to sustain power was breaking down in a world where financial leverage outweighed ownership. The Iranian crisis accelerated this reckoning. Within a few years, Britain would face similar limits elsewhere. The lesson learned in Iran shaped future decisions. Avoid prolonged confrontation over assets that could not be defended economically. Retreat when necessary, before costs spiraled. Preserve stability, even at the expense of status. These were not ideological choices. They were financial ones. At home, the public narrative lagged behind reality. Many still believed Britain remained a major imperial power, temporarily constrained but fundamentally intact. The visible symbols, navy, diplomacy, institutions persisted. What changed quietly was the ability to sustain them without borrowing or compromise. Iran's nationalization had forced Britain to confront that gap earlier than expected. Globally, the episode reshaped the energy order. Oil-producing states recognized that control over resources could be asserted. If not absolutely, then meaningfully. Consumer states learned that access required partnership rather than command. The balance of power shifted away from empires and toward systems. The United States emerged, strengthened not by taking oil, but by mediating access. Its financial and political weight allowed it to shape outcomes without assuming ownership. This model indirect influence through markets and alliances defined the post-war era. Britain adapted, but at a price. The loss of energy dominance fed into a broader retreat from imperial commitments. Maintaining far-flung influence without guaranteed resources became untenable. One by one, obligations were reduced. Bases closed, roles redefined. What had been an empire became a network of relationships, important, but no longer controlling. The oil war in Iran did not bankrupt Britain in a single dramatic moment. It did something more consequential. It exposed the limits of Britain's economic power and forced decisions that accelerated imperial decline. The collapse was quiet because it was rational. There were no parades marking retreat. No speeches announcing defeat. Just a series of calculations, each acknowledging that the costs of control exceeded the benefits. Iran was not the last challenge, but it was the one that made denial impossible. This is why the story matters. It shows how empires do not always fall through conquest. They can be undone by contracts, currencies, and commodities they can no longer command. Power, in the modern world, is sustained not by possession alone, but by the ability to pay, to supply, and to endure pressure over time. Britain's confrontation with Iran revealed that truth in its starkest form. Oil had once been the foundation of British strength in the Middle East. In the end, it became the instrument that exposed Britain's weakness. The empire survived the war, but it could not survive the price of keeping control. And in that realization, the age of imperial energy dominance quietly came to an end.